What if almost all the money sitting in your bank account doesn't actually exist? What if every dollar is born as debt? And the entire global economy survives only if that debt keeps growing endlessly. This isn't a conspiracy or a dramatic exaggeration. This is the underlying mechanism of the modern financial world. A machine that silently creates money out of nothing, accelerates until it breaks. And when it breaks, it reshapes the world around us. Today, we are pulling back the curtain on what I call the debt engine. The system that controls everything from growth to crisis to your daily life, often without you even noticing. Most people imagine money as something physical. Cash printed by governments, coins, or numbers in your bank account that represent something stored safely somewhere. But the truth is far stranger. Money today is mostly digital. Not digital like Bitcoin. Digital like entries inside a bank's internal ledger. And those entries are created the moment someone takes out a loan. Yes, loans create money. When someone borrows, new money is born into the system. When loans are paid back, that money disappears. So when you hear people say there's not enough money, what they're really saying is, there aren't enough loans. The entire financial system grows when people go deeper into debt. Let's slow down for a moment, because this is where the debt engine reveals itself. Here's the simplified version of fractional reserve banking. Imagine you deposit $100 into your bank. Most people believe the bank stores that money until you need it, but that's not what happens. The bank keeps only a small portion, maybe 10%, the remaining $90. Get loaned out to someone else. That person spends the $90, and eventually it gets deposited into another bank. That bank keeps 10% and loans out the rest again. And this cycle repeats over and over, multiplying money far beyond the original amount. Your $100 becomes the foundation for hundreds of dollars in new loans and new money. It feels magical. It feels impossible, but it's not magic. It's accounting. Because loans create money, the economy only has enough money when people are borrowing more. If borrowing slows, the money supply shrinks, and the entire system starts to strain. The debt engine needs constant acceleration. It's like a machine that must always be fed fuel. When people borrow, the economy expands. When they stop, money disappears. This is why downturns are so violent. When confidence drops, people stop taking risks. They borrow less. Banks tighten lending. And suddenly, the system doesn't have the fuel it needs to run. Central banks know this. They watch the engine constantly, and when lending slows, they panic. They cut interest rates. They encourage borrowing. They pump money into the system. They do anything to keep the engine alive. Because here's the frightening truth. If the engine stops growing, it collapses. The clearest example of the engine overheating and breaking was the 2008 financial crisis. Banks were desperate to create more loans, which meant creating more money. So they started handing out mortgages to almost anyone, even borrowers who couldn't possibly afford them long term. These risky loans were packaged together and sold as safe investments. And for a while, everyone believed they were safe, until they weren't. When those loans started failing, everything collapsed at once. Confidence evaporated overnight. Lending froze. The debt engine stalled. And the money it created began disappearing just as quickly. The result was catastrophic. Mass foreclosures, failing banks, millions unemployed, and the deepest recession in modern history. But instead of redesigning the system, governments chose to restart the same engine. To revive it, central banks created something called quantitative easing. In simple terms, QE is the debt engine on steroids. Central banks created massive amounts of new money to buy assets, hoping banks would start lending again. And it worked. Kind of. Asset prices exploded. Stocks soared. Real estate doubled in value in many places. But wages didn't. People felt like life was getting more expensive faster than their paychecks could keep up. The rich got richer. Everyone else tried to stay afloat. Quantitative easing didn't fix the system. It amplified its consequences. Today, the debt engine is larger and faster than ever. Governments rely on it. Corporations rely on it. And ordinary people rely on it without ever realizing how fragile it is. Every economic boom, every crash, every bubble can be traced back to the same mechanism: money and debt rising together. It is a system built for endless expansion. On a planet with limits, whether this is sustainable or not is the question economists fear the most. But understanding the engine, how it works, and why it behaves the way it does, is the first step to navigating the world it creates. If you want to understand where the debt engine is heading next, you need to look at the system trying to replace it. Watch our next video on the origins and hidden purpose of cryptocurrencies. Like and subscribe for more documentary-style breakdowns.